First in, first out, or FIFO. Let's assume that the business bought 5 units at $10 each in the first purchase. In the second purchase, it purchased another 5 units for $12 each. The business sold 3 units. What is the cost of the units sold? We are using FIFO, hence the assumption is that the first goods purchased became the first goods sold. Since the business is using FIFO, we will assume that the 3 units sold are those units that were first purchased. The word assumed is important because, irrespective of the physical units that are sold, we still assume that they are still coming from those units which were purchased first. In this case, it will cost $10 per unit. So if we return those units back to the warehouse and brought another 3 units out, they are still going to be valued at $10 per unit. Accordingly, cost of goods sold equal $30. So what is left in inventory? 2 units from the first purchase at $10 each and the 5 units of the second purchase at $12 each. Total inventory is $80. Notice that the cost of goods sold is valued at the lower cost, while the inventory is valued mostly with the higher prices, which are close to the current market price, or the latest purchase price in this case, assuming that we are living in an inflationary economy. Let's assume that the business sold another 3 units. How are we going to cost them? We are still assuming that they came from the first purchase, and when it ends, we will start withdrawing from the second purchase. If you remember, we had 2 units from the first purchase left, so we assume that they are sold first. Then, we will release another unit from the second purchase, leaving 4 units in inventory, each for $12. The total cost of goods sold, including the one sold earlier, is now $62, and the ending inventory is valued at $48. Let's now take an example to apply this costing method on both the periodic and perpetual inventory systems. Let's say a business has a beginning balance of 5 units for $10 each. Accordingly, the period started with 5 units. In the periodic system, we just record the units at the beginning of the period and the units purchased. We don't keep track of the units that are sold. On May 10, it purchased 10 units for $15 each. On September 28th, it purchased another 10 units for $20 each. The business took a physical count and found that there are only 7 units left in the warehouse. Here is a summary. A business has a beginning balance of 5 units for $10 each. On May 10, it purchased 10 units for $15 each. On August 14th, it sold 11 units. On September 28th, it purchased another 10 units for $20 each. On November 5th, it sold 7 units and didn't do any further transactions regarding this product till the end of the period on December 31st. Let's calculate goods available for sale to derive the goods sold. The goods available for sale is equal to the beginning inventory plus purchases. In our example, the beginning inventory is worth $50, the first purchase is $150, and the second purchase is $200. The total number of units available for sale is 25 units, and their value is $400. Since the ending inventory is 7 units, we can derive the cost of goods sold by subtracting the ending inventory from the goods available for sale. It is equal to 25 units minus 7 units, which equals to 18 units. So the business sold 18 units. Since we are using FIFO, then the first units that came in are assumed to be the first sold. So the 5 units of the beginning inventory are sold, followed by the 10 units from the first purchase, then 3 units from the second purchase. This leaves 7 units from the second purchase in the ending inventory. Accordingly, the ending inventory is equal to 7 units times $20 each, which is $140. The cost of goods sold is equal to $260, which is derived from $50 of the beginning inventory plus $350 of total purchase minus $140 of the ending inventory as stated above. Let's now see how we are going to cost the goods using the perpetual system. In a perpetual system, we keep record of all the flow of goods, whether buying or selling. Each single inventory item has a page in the inventory subsidiary ledger. It looks as follows. The main three categories are purchased, sold, and balance. So we started the period with a beginning balance of 5 units costing $10 each. This will be recorded in the balance with a total value of $50. On May 10, there is a purchase of 10 units for $15 each. Such information is recorded under the purchases section as follows. The total value is $150. This comes from the multiplication of the number of units by the units cost. Now the balance is composed of two layers, one representing the beginning inventory and the second represents May 10th purchase as follows. So although they are two layers, we know that we have a total of 15 units for $200 in inventory. On August 14th, the business sold 11 units. This is recorded under the sold section. Notice that we are using FIFO. We are going to assume that the 5 units from the first layer, which is the beginning inventory, are sold first, then followed by another 6 units from the second layer, a total of $140. This leaves 4 units in the balance. Since they are from the first purchase, or the second layer, the cost of each is equal to $15 and their total cost is calculated by multiplying 4 units by $15, which equals $60. On September 28th, the business purchased another 10 units for $20 each. This is recorded under the purchase section like this. Then, under the balance section, we are going to update the balance. Since the new purchase is at a different price, we again form two layers. The first is 4 units at $15 each, and the second is 10 units at $20 each, with a total value of $260. On November 5th, the business sold 7 units. Since we are using FIFO under the sold section, the 4 units of the first purchase should go first, then 3 units from the second purchase with a total cost of $120. This leaves 7 units in the ending inventory for $20 each. At the end of the period, cost of goods sold is calculated by adding all of the value column under the sold section, which is equal to $260. The ending inventory represents the last figure in the balance section, so it is equal to $140. Notice that under FIFO method, the cost of goods sold and ending inventory is the same, whether we use the periodic or perpetual system.